Well, hello and welcome to Trading Blows from TraderX. Another busy show ahead, plenty for us to discuss once again as the markets remain pretty choppy across the board. We have a look at whether the recent gains in risk assets, albeit they fizzled out a little bit on Tuesday, whether equities can continue pushing to the upside. We also examine the hawkish repricing that's going on in rates markets as markets suddenly wake up to the fact that the Fed may not actually cut rates this year. We also regrettably have to talk about the debt ceiling drama going on over in Washington, D.C. And we also talk about the UK economic outlook after another disastrous inflation release. Without further ado, let's get on with the show. So, as I said, plenty for us to discuss. Let's bring in the panel. As always, they'll go head-to-head over 4 rounds. They'll score points for a great response, and they'll have the threat of points being chalked off if a dispute is raised over their answer. Of course, as always, the better the response, the more points they will score. Now, I'm tempted to dock everyone a point for their sartorial inelegance this week, but I'm feeling nice, so I shan't. Joining us from down in South Africa, the most talkative man who's ever been on Trading Blows, Arno. We've also got Richard Matthews, a senior broker over at deliverable FX firm Pardus FX. And now that he's managed to work out exactly what the Reuters calendar has been saying this morning, Adam Linton, the head of the European desk at Newsquawk, a provider of real-time audio headlines and market analysis. With all of that said and done, let's get into the first round of the show. Well, I've got to admit that perhaps I'm some sort of an inverse contrarian market indicator at this point. When we put this show together, we film it on a Wednesday. I send around the topics that we're going to discuss the Tuesday before we get going. And when I sent it round yesterday, I asked the guys the question, is the risk rally that we're seeing sustainable? And then within about 8 or 12 hours of me sending that email, equities were 1.5% lower. So kiss of death coming from me there. Arno, I want to start with you first. Obviously, we saw this breakout in US equities last week. The S&P, the Nasdaq, they've come back below some of those levels as a result of the selling we saw on Tuesday. Where do you think the market heads next?
Yeah, well, if you look at the entire market, we've had a couple of big breakouts, obviously, in the last week. But, if you look at the Nasdaq specifically, that's really where most of the inflows have been going. Even though we had the S&P trying to break out of that recent range, we had the DAX trying to break out of that recent range. Both of them have basically dropped back into that range. So it's only really the Nasdaq that's been outperforming. And I think right now markets are looking for something to cling to. And they just haven't found that yet, right? Now, in terms of sectors and geographies, it's really tricky to find a lot of conviction in this market right now for me personally. But I would be looking at 2 areas. Now, in my defense, the DAX, even though we've seen a big run to the downside literally over the last few hours, it is a market that I've been looking for shorting opportunities in. It's not something that I'm short already. The reasons why I think the DAX specifically is a little bit too lofty priced at these levels is because, European equities have been large. We spoke about this a few weeks ago as well. They've been largely supported over the past few months because of really 2 things. The first one was that China reopening, where everybody expected the luxury goods sector to really outperform. And to be fair, it has. But if you take a look at the recent Chinese data and Chinese equity markets, we're not really seeing that optimism from the China perspective anymore. And I think a lot of that has been discounted. Now, apart from that, at the start of the year, we went through that whole that saga, that Europe or nothing frenzy that the markets went into, with everybody expecting growth to rebound and not be as bad as expected. And I mean, we've been very vocal about that over the past few weeks. We just didn't see that happening. And now it looks like the data is just, catching up to that view. So the 2 main reasons why equities, some of the main reasons why equities on the European side were higher is now not there anymore. China's reopening isn't as firm. The data isn't as solid. So for me, DAX looks a little bit overpriced at these levels. Now, it is true that most of this index is being held up by about 8 names at this stage. So the weightings, if those names continue to outperform, then obviously there can be some further upside. But I will be actively looking for shorting opportunities in the DAX because from a growth perspective, I don't buy into this upside. Now, on the US side right now, we've obviously had a massive amount of tech outperformance. That's been the standout mover. That's all that the markets have been talking about, over the past 2 weeks. Now, there was a very interesting chart that OptionBit had up a few weeks ago where they looked at the different types of rotations that you see into and out of sectors based on certain economic regimes that the markets are pricing in. Now, when markets expect lower inflation and higher growth, basically an expansionary regime, they tend to see two things. They tend to see massive inflows into tech and massive outflows out of utilities. Now, if you take a look at the recent Bank of America, the flow survey, what we've seen there is that tech has been a massive inflow mover. Everybody's been flooding to that. And utilities are at the bottom of the pile. So that for me suggests that, some parts of this market is pricing in lower inflation and higher growth at the same time. So the obvious risk here is that if prospects for growth were to massively deteriorate in the next few weeks or so, then a relative play maybe of something like long utilities and short tech. I know that's at these current levels with momentum, that's a very, very risky bet. But if you're looking at, where I think the markets might be offside is if growth starts to see a massive deceleration, then I think that relative play would be something that I would consider. So that short opportunity is something I'm looking at. Then obviously a relative play for utilities versus tech, but that is if growth decelerates. So right now, I don't want to be. I'm not actively invested in any of these markets. I think right now it's nice to be able to sit out of this noise and just have your money market fund give you 5 or 6, and in my part of the world, the money market fund is actually a little bit higher, which is great. But if you can get that 6-7% and sit out of the noise, there's nothing wrong with that at this stage until we get more clarity on the macro side.
Yeah, absolutely. And I think that's obviously something that is playing on investors' minds, at least the way I see it. The bar to actually invest in the equity market is that much higher because you can get such a significant, or in recent times, such a significant nominal return on your risk-free rate in money market funds or in a deposit account or whatever it may be. Adam, I want to go to you and pick up on a point that Arno mentioned. He said right at the start of his piece there, the market's really struggling to latch onto a narrative. In terms of narratives, in terms of risks, what's really on the horizon for equities at this point?
Yeah, so, kind of the way that I'm framing it is just it kind of expanding a little bit more on this concept of breadth, particularly when you look at the US market. I think we've talked about this on previous episodes where a lot of the gains of the S&P 500 have been really heavily concentrated in some of these large cap names, which have got a large tech bias. That's Apple, Microsoft, Tesla, Amazon, and Nvidia. So year to date, their gains are around 39.4% compared to S&P 500, which is 9.9% yesterday. So it shows the real divergence that we're kind of seeing at the moment. And from a fundamental perspective, from a tech angle, yes, there has been this AI story. But I think even if you do buy into that, I think some of these gains have been particularly outsized. And I think, one thing, and John Authors did a good piece about this, is if you don't necessarily look at the year-to-date performance, but if you go back to August last year, and that's kind of when we saw like a little bit of a descent for some of the tech names, and we saw some of the portfolio managers get like heavily underweight of these names as we were in a rising rate environment at the time, and they weren't benefiting to the same extent as when we're in zero interest rate policy. And basically, all we've kind of seen this year is basically just portfolio managers just reweighting, and then we've basically kind of just reversed that performance. So, yes, it's been a bullish start to the year, but when you put in the context of where we were last year, it's more kind of just a reversal of some of that price action that we've already seen. And so, therefore, what's the catalyst for upside in those sectors? I don't think it's necessarily that evident, in which case then you kind of probably want to see a little bit more in the way of participation and a little bit more breadth within the market, which is something we're not really seeing. And then just kind of underscoring that, John Authors made the point that it's the weakest breadth for any major bottom of any new uptrend over the past 30 years. So really is showing that things are lacking at the moment. And therefore, so for some of these companies to kind of join the fold, I think you need a fresh macro impulse. And at the start of the year, I think we did one of these first shows maybe in February or March time might have been. And, I was kind of making the point that, second half rate cuts, could see a second half start of the good, solid second half of the year. But I think we're getting a real dangerous calendar effect now. I think it's May now, it's June next week. And, the more that we don't, the Fed stays on hold, elevated, could potentially go again, then the less likely these kind of second half rate cuts happen, unless you get some sort of economic, not to say catastrophe, that's maybe oversexing it up a little bit, but, you need a swifter deterioration in the US economy than you probably otherwise would have got, bear in mind where some of the market expectations were at the start of the year. So I don't think it's necessarily clear, what the real bullish case is now, because, I think if the Fed were to deliver these rate cuts, I think it's because more a case of something's gone wrong than something's gone right. But, if you do take if you take the S&P 500, for example, there could be something left field, which, isn't necessarily on our radar at the moment. Because if you kind of zoom in on the S&P 500's returns this year, about a bulk of them took place, I've got down here, between March 13th and April the 13th, which has basically coincided with the Fed's bank term funding program. So, whether, we could get an extraordinary program like this, doing a different extent in the second half of the year, which could help. But other than that, I'm not necessarily sure what the macro impulse here is. And as Arno said, for European assets as well, it's even less clear. Those two, feel good stories at the start of the year, the softer energy prices, and more importantly, China. The data for China has been pretty soft. Inflation's been soft, activity data has been soft, credit growth has been soft. And, a perfect example of, the problems for Europe is the luxury sector. Yesterday, LVMH was down 2-3%. It wasn't really clear at all why. I've checked it open again. It was down again. That's been one of the darlings for the European market this year. And I think we're seeing a real turning in sentiment here. There was no one really kind of knew why, which I thought was interesting. There was a couple of notes people were circulating, but for the moves, I think they're kind of outsized. And we now, as a sentiment indicator, we're seeing Bloomberg run articles of the LVMH owners lost 11 billion euros, all that sort of stuff. So I think when you're in that territory, you kind of see a little bit of turn in the sentiment. And given in mind that you're not going to see a constructive monetary policy outlook in the ECB, they're still going to keep tightening to some extent. Then, I think I'm not constructive at all on equities. I don't think we're necessarily going to have a mass sell-off, but the kind of feel-good story of the second half of the year I'm not really seeing it at the moment.
Well, there we go. I thought I was the pessimistic one on this show, but you two have really depressed us all. I think it's interesting, your point on the second half rate cuts. I think it was Marco at JP had a piece out very similar to what you were saying earlier in the week, effectively saying, if we do get rate cuts, you've got to think about what causes the cuts rather than necessarily just going, the Fed have loosened policy, that's automatically bullish for equities. Dick, let's bring you into the show. The S&P is trading roughly 41.50 when you look at the front month future. The next 150 points, higher or lower, and why?
I'm going to lose a point here.
Oh no!
I'm going to actually mention the debt ceiling.
No, I can't dot your point, because if you look at the bottom, we're actually going to talk about a whole round on it later.
I would gamble 150 points lower, and I'm actually not sure you even see 150 points, but I think you could see it move quite a bit lower. And we'll come back to the debt ceiling later on, but I think the debt ceiling's weighing quite heavily on the top of the markets at the moment. And what any deal will mean to the markets. There's a thing on Bloomberg, a piece on Bloomberg earlier today, and the agreement will mean I think something like over 500,000 jobs are lost. Whether that's true or not, it's another matter, but obviously that will impact the markets. I just want to circle back on LMBH that I was talking to a very good friend who drinks a beautiful rosé called Minute, like it's water. And he was saying that LMBH had just paid way over the top for it. I think it might be 400 million or something. And he actually knows the owners who are just laughing all the way to the bank. So just wonder if that underlying was hurting LMBH along with China, obviously.
I was going to say, we have, haven't we? This has now become a wine tasting show as well, by the sound.
Well, I don't, as you know, I don't drink. And although I have a glass of Ibina, and people often think that's a glass of rosé, but my wife loves it. It's a beautiful drink. But a very good friend of mine plays golf with the owners, and he was laughing about that.
Well, there we go. Dick Matthews tells us why LVMH just sold off the Open 2 days running. I mean, that's a bonus point right there.
Just circling back to Adam, they're not going to be rate cuts. Yeah, let's just put this to bed. And people are gradually coming around to my way of thinking that rates are still going to carry on going up. Why would the Fed cut? All you youngsters all think that the natural sort of level of interest rates is 1 or 2%. It's not. We're in a brave new world, which is going back to the old days. interest rates are going to stay high, and they're going to stay high for a long time. They ain't cutting this year. They're going to put rates up again on my dead mother's body. So I think that will start to weigh on the market as well. Obviously, you've got PCE coming out at the end of this week, which I think might surprise on the upside again. Liquidity might be starting to dry up, and M2 looks very, very like it's shrinking very, very rapidly. I think it's the 5th month running that it's shrunk, so it might be liquidity being sucked out of the market. So all of those added together, apart from LMDH, because obviously you would be drinking your toast to the short position if you got it right with Minusay. I think all of those add up, and they just sit there and they weigh on top of the markets at the moment. Away from that, employment seems to be still pretty good. I think GDP is holding in there. So, yeah, there's really no reason for rates to be cut. And this is I think just sits on top of the market, and people are eventually going to say, oh my God, they're not going to cut rates. You know, we should stick in cash. Why stick in equities? You know, so
well, we're going to get onto that in a second, and we will move on to the next round in a moment. I just want to ask one very important question first, which is, how much commission are LVMH paying you for the product placement of that rosé?
Nothing better to drink on a summer's day in the south of France.
Right, before Dick gets us in trouble with the advertising people, let's get on to the second round. Well, Dick, we may as well continue the conversation with you, actually, considering you brought the topic up. We have had this big hawkish repricing. You firm in your belief, as you have been for some time, that rates aren't going to be cut this year. I must admit, I agree with you on that point, barring some sort of economic catastrophe. And if you look at rates markets, we're starting to see them wake up. If you look at the 2-year Treasury, for instance, we rallied, we sold off around about 30 basis points or so last week. I think that was the biggest 1 week rise since last September, and the yield is continuing to rise into this week. The Fed Fund futures curve has now got 40-ish basis points worth of cuts priced in. It was about 75 this time last week. So, well, the first question I'm going to ask, I think I know the answer to, which is, do you think that can continue? And the second is, do you think this can continue putting a bit of upward pressure on the dollar, which has also started to rebound in a bit more of a significant way?
I'm going to dodge the questions, actually. I'm going to just come back. Because
not wine, not rosé.
Just going back to wine. I don't even think so. I don't know why I'm talking about wine. It was quite interesting that the market just suddenly got a change of mood, didn't it, last week? Which, interestingly, was on Ascension Day. I claim my extra point there. With thin markets, I think people it's very rarely one thing moves the market. It's often a culmination of things. And I think a quiet market, and that just the market started shifting a little bit and the mood started changing. Whether this Monday, which is Whit Monday for those of us who are not religious, you should know all about Whit Sunday and Whit Monday. A holiday over here, and much of Europe will be shut. So again, you're going to have thin trading. So you could see a little bit. Sorry,
on that, it was also, Adam can correct me if I'm wrong, I'm sure, Memorial Day in the States on Monday as well.
So, you could have a really thin weekend. Clock's obviously ticking towards a subject that we can't talk about. And I've forgotten what the question was. I still like the dollar. I've liked the dollar for a long time. I still think that we're going to get high for long, which I said before. BlackRock and Bank of America now agree. They're seeing 6%, and it took me, 25 minutes before I mentioned the dreaded 6% Fed funds rate, which I think we're going to more people starting to talk like that. And interestingly, people have been bemoaning the lack of volatility in the FX market. It's always like people are going, okay, well, let's put our feet up now. We've got to a level of rates which are near damn it to the top. We're not going to move rapidly downwards. We're just going to sit here. And I think that's just sucking volatility out of the markets because they just don't want to play. Having said that, in a way that will help the dollar on carry trades because it's such an attractive rate in the States. So I still see the dollar holding in there. Yields still look pretty good. Housing market looks okay. Personal consumption, obviously, a thing to watch at the end of the week. And obviously, the only dark cloud on the horizon that I can see for the US is this money supply, which is starting to drop really, really rapidly. But again, people are still talking about a pivot, and it's not a pivot, it's a pause. And there's there's a big difference between the two words.
Yes, most definitely. I mean, some people are even now, the vernacular gets more ridiculous. Some people are now even talking about a skip, and we might miss.
I was going to say that. Am I banned from saying that or not? I was,
We'll see. Go on. I won't finish my point because otherwise I'll steal everything you've written down, Ads. Off you
go. So kind of from my perspective, in terms of this hawkish repricing, I think a lot of it's been backed up by the data. I think if you're a Fed official, you're kind of looking at things like the retail control groups held up very well, industrial production's been good, some of the prices paid elements of some of the survey data, they've been on the rise as well. And obviously you saw that kind of blockbuster labour market report a few weeks ago as well. So from that perspective, that kind of picked up a little bit of the hawkish pricing. And then if you throw in that the comments from Bullard, who again, he's a hawkish outlier and non-voter, but more importantly, Logan, they kind of put the prospect of a June hike more on the table. That being said, we did kind of see, from some of the thought leaders, Powell, Williams and Jefferson last week, they did kind of temper expectations, and the market has kind of sided with them for June. And I think so a June hike is about 28% now, so probably won't get it. But I think the messaging around the Fed's really nuanced now. And at the time of the May meeting, in the aftermath, if you said the Fed they're not going to hike in June, I think most people have said, okay, that's probably terminal. Now, I think what we're kind of seeing from the Fed is, we probably won't hike in June, but we're kind of more playing for time now and more in a wait and see mode, which yes was technically true at the time of the May meeting, but I think it's become more explicit now. And like you said, that's how we've kind of developed from this pause to a skip. So that's what I think we've kind of seen a little bit more of the hawkish reprice. I think also, as mentioned in my last answer, there's a huge calendar element at play just by the fact that the longer we go with potential rate hikes on the table, the less likely there are for rate cuts further on in the year, and they may get priced out completely. But more importantly, nobody at the Fed is even remotely entertaining the idea of a rate cut this year. So some desks are looking for as much as 100 basis points of rate cuts. I think at this point, they're just saving face. The game is just completely up on that front. And like I said in my last response, you kind of need at this point something to really go south in the US economy to get those rate cuts. And, I don't necessarily see where that's going to kind of come from at this stage. I think as long as the labour market remains tight, which, it is, unemployment rate's 3.4% at the moment. Fed's got it at 4.5% a year end. They've got plenty of room to move on that front. Services inflation is still a concern. And if growth holds up, then they've got every confidence to, either keep rates at these levels or just keep going. So, I think, I think the Feds aren't going to be cutting anytime soon. I think we could potentially get another hike in July. And I think all this, favours the dollar pretty massive. I'm pretty constructive on the dollar at the moment. I think, rightly or wrongly, in the short term, and if we're allowed to mention the Voldemort of markets, the debt ceiling, the dollar can be supported by what we expect to be a resolution to the debt ceiling. It's more kind of avoidance of a short-term negative growth shock. And then from relative perspective, from growth, in terms of a growth perspective, Eurozone's looking like it's faltering. China, we've touched on already. I think that favours the dollar. I think the ECB tightening is about as hawkishly priced as it can be for now. I don't think the euro is going to be able to outmuscle the dollar anytime soon. I've mentioned on the previous episodes, I think the yen tightening story can only underwhelm. If they do anything, it'll be far from linear. There might be some pockets of strength against the dollar, maybe Aussie if they go again, or Bank of Canada. But ultimately, where we are in the dollar index, we've still got another 2 points before we make some of the year-to-date peaks. I think, short term it'd be good to be constructive on the dollar based on what we've seen.
No, I'd certainly agree with that. And I'm glad you brought up the Fed's forecast, because I don't think that, obviously we get another round of forecasts on the 14th of June at their next meeting, but I don't think it's getting enough attention because people are saying, the labour market's going to soften from now to the end of the year, growth's going to slow, et cetera, et cetera, et cetera. We've got to remember the Fed have already told us that they expect this to happen. So unless, as you rightly say, unemployment rises above 4.5% or growth slows significantly more than they expect, it's not actually that much of a problem. I would argue it's actually what they want and need to see in order to get inflation under control. Arno, let's bring you in. What are your thoughts on the dollar at the moment? Adam and I are both pretty constructive. I think Dick's pretty bullish as well. Are you going to make it a full house?
Absolutely, mate. I mean, let's start on the yield side first. The yield move, I don't think that is the only reason for why the dollar has been pushing higher, because the dollar is actually, it was the first mover. The dollar moved before we had yields moving up. And I think there's another reason for that, and I'll touch on that in a second. Actually, Adam and Dick basically, touched on all the points that I thought was important about this. So I'll just add some color to that. In terms of the yield move, I do think it is looking a little bit aggressive in terms of the size. If you asked me a week and a half ago, if the data that we had and the comments, if you gave me the data and the Fed comments that we've had over the last, let's just call it 5 days, and you asked me whether that was worth 40 basis points on the 10-year yield, I probably would have said no. Maybe it was worth 10 basis points or 20. So the move has been a little bit aggressive, and I think there might be something else playing into the mix here, because we spoke about this in the previous point where, if you take a look at the way that certain markets react in different economic regimes, if you look at the move we've had in equities, barring the move we had obviously earlier today, alongside that of yields in the dollar, it does look like the markets are starting to trade maybe in line with a little bit of a US exceptionalism, even if it's just in the short term, because like Adam mentioned, you have China pushing lower in terms of the data. European data has been bleak. For the UK, it's hanging in there, but it's not something to be overly excited about. So if you take a look at the US economy, even though there's been a lot of cracks, it's still doing quite well. And the aggregate of the data has been more good than bad, right? You had PPI pushing lower, which was bad. You had consumer sentiment coming in low, which was bad. Empire State, but that's very choppy. Existing home sales missed as well, but new home sales was okay. NHB was okay. We had that huge, strong jobless claims and continuing claims last week, which was quite a surprise. The Philly Fed came in solid as well. So right now, and retail sales, like Adam mentioned as well. So I think apart from the fact that this allows the Fed to stay more aggressive, if you take a look at rates markets, the money markets haven't jolted higher in terms of their expectations for what the Fed will do compared to what we've seen in yields. Right? If you take a look at money markets right now, we're pricing 8 basis points. So we're about 32% probability towards a hike. I think the move in yields might be a little bit, might be pricing in more than that. That's what I'm trying to say. So I think what the dollar and yields have been doing over the past week, apart from just looking at the Fed, and yes, I do think that's the case, I think it's also a little bit of US exceptionalism playing out with the data being much better in the US compared to that of the rest of the world. Now, like we've been bearish on the euro for quite a while. So euro dollar has been a favorite play of ours. We've been short that. We closed out most of those positions early or at the end of last week, which was a good run. But I'll be looking for any type of dips right now in the dollar, as long as we can, I think, stay above that key multi-year level of 103. I think that shows a lot of bullish momentum at this stage. So if the data holds up as it is, if the Fed, even if the markets doesn't price in a hike officially for June, based on just the fact that we've had that very good growth differentials playing out, I do think there's more upside for both yields as well as the US dollar.
Well, there we go. $4 bulls out of 4. It's quite rare to get a consensus on this show. Let's see if we can carry that on in the second half. Let's move on to round 3. Right, we've got to talk about the UK. We'll let Dick compose himself and go to him in a moment. We had the PMI data on Tuesday, which was all right, actually. You've still got this divergence between services and manufacturing, but things are starting to look a little bit brighter, or relatively brighter when it comes to the economy. But then, of course, you had the latest inflation figures this morning, which were absolutely catastrophic. Headline inflation coming in at 8.7% year on year, well above expectations. The core number coming in at 6.8%, which is the highest since the early 90s and showing absolutely no sign of slowing down. So we've obviously had a pretty violent reaction in UK markets, and we're filming this while UK markets are open, but the 2-year gilt is on track, I think, for its biggest one-day rise since the mini budget. The OIS curve is pricing a terminal bank rate just shy of 5.5%. Adam, let's go to you. Where does this leave the Bank of England and the UK economy more broadly? Is Is it as bad as it looks?
I need to be careful. I don't want Dick to shout at me if I say no. But
we can mute him for a moment.
I mean, so as you mentioned, we saw the PMI data, yesterday, which obviously did get a lot of focus. I think the prospect of diverging fortunes in the manufacturing and services sectors has been, pretty thematic across the globe at the moment. Yes, there were some potential positives. Some of the manufacturing input costs on the decline, and yes, this can have follow through to other sectors, but the services sector is just still going gangbusters at the moment. Even in the face of rising prices, people are still piling into services. They want to eat out, go to restaurants, etc., etc., and all they're doing is just having a preference for services over goods. So that was the kind of backdrop to the inflation release, and then we saw it, and yes, we saw a decline in the headline, but that was widely telegraphed. That's just an energy impact that was, we were always going to see. The problem was, as you said, it just didn't decline as much as expected. It was 8.7%. MPC looking for 8.4%. So I think that's a new personal record. What was that, 2 weeks? And they're forecast automatically in the bin? Is that,
Well, I mean, if we wanted to be really disingenuous, we could say 1 day, because I think they repeated them to the Treasury Committee yesterday.
Well, there you go then. So we'll see again in August. We'll have another go then. But yeah, like I said, this is just every turn the Bank of England just been caught wrong. I was saying to the guys on the desk today before the release, if you ahead of any UK inflation release just went, positioned yourself for a hawkish outturn, I wouldn't be able to sat next to these guys every day from 6 a.m. because it's just been absolute bad news after bad news for the UK. And, it's getting to the point when it's getting increasingly problematic because some of the energy effects are dissipating, and by the time we get to October, they'll actually be acting as a drag. But the food inflation's rampant, services inflation's rampant, and all the Bank of England can do now is just keep hiking rates and just try and crush the inflation outlook. But growth is just really going to take a hit now. Previously it was kind of walking a tightrope. I think the phrase that Bailey said is like the tightrope doesn't exist anymore. You're at the bottom of the Grand Canyon shouting for help. And so I think they're going to have to keep hiking rates. But I think what was most telling was the market reaction to today's release. Everyone with their economics textbooks, if inflation comes in hot, you buy the currency because rates are going to be higher. Yes, we saw a bit of a spike high in cable, and then since then we've just been getting hit. Because now it's a case of, it's the worst of all worlds, rampant inflation, probably soft growth. If anyone's remortgaging this year, good luck. And, this will eventually hit the household consumer. It will filter through to the household consumer and hit inflation. But the Bank of England are just in a mess. I don't think, a lot of it is their own doing, but some of it's like exogenous factors they can't control. But in terms of what they do and how they navigate out this, they just need to just keep going and just hope. That's, I think, all they've got at the moment.
I think you're right. And when we're talking about the Bank of England, I have Newsquawk in front of me, and I have a headline crossing that is going to make Dick's head explode. So we'll get your reaction on this. Let me read it.
Can I just do one trade recommendation? I'll be
go on.
Short sterling, long psychiatrist for City of London workers.
Great trade. So the headline is, and if this is wrong, then Adam, we can blame you because it's your service. Bank of England Governor Andrew Bailey says at Wall Street Journal event, and I quote, "Our projections show the inflation target will be met this year." Dick Matthews, your thoughts?
Well, I've got all my pills here. I've got Gaviscon, gastrointestinal pills, Buscopan to try and calm me down. I've had my blood pressure pills and a nice long swig. So I'm actually really relaxed about this. I quite like the idea of Andrew Bailey walking on a tightrope. Might sort the problem once and for all.
Have to be a strong tightrope.
Sorry to interrupt. There's just been a correction to that headline. It was the inflation target of Venezuela, I think it was. Sorry,
yeah, well, I'm sitting at home because no one will sit next to me now. I've been banished to have to sit at home because I rant on so much about the Bank of England. It's interesting that gilts have moved like that. Is Liz Truss back in power or something? Rachel Reeves has got to find something else to blame it all on. All joking aside, It is a real mess there, and I've been in the market, and I know I'm going to go on and get booed for saying this for nearly 50 years. I've never seen a central bank get in such a mess as they have now got themselves in. Interestingly, the IMF, the Institution of Miserable Failures, or is it something else?
You can have a bonus point for that.
That's got to be a point.
I changed it from the first word I thought with F. A forecasting growth of 0.4%, which they've revised upwards, but unfortunately they very rarely get it right. But I do tend to agree with Adam. I think that we've got this dreadful stagflation. I'm the first person to mention it today, and although it's very, very weak growth, there is some growth, and restaurants are buzzing, and there are people out and about and spending money. How long this lasts, if people come off their mortgages and they renew their 2-year fix or whatever it was, I think they're going to have such a great shock when that happens. My concern is that I am harking back to the old days, to the 70s and 80s, when you've got this wage price spiral. And now when you pick up the newspaper, we've got train strikes next week, I think it is, which is very nice.
Joy.
Let's go to the cup final. You've got junior doctors striking, and they all think that they must have these incredible pay rises. Well, those of us who aren't in the public sector, we just have to tough it out and try and do the best we can. But to me, one of the problems the UK has got, I was reading a figure last night that 1 in 3 people are now employed by the public sector. So the power they have over the private sector is just unbelievable, and they're not productive. But they're the noisy ones who get the wage demands, and I think that's just going to squeeze and squeeze and squeeze. Interest rates, what difference does it make if you move it by 0.25%, 0.5%? They should stop effing around and go, right, base rate is 7%, end of story, and just knock it on the head, because you're not going to get inflation down here or in the States or in Europe without breaking something first. Sad as I am to say it, I've never seen inflation drop rapidly without a recession. And I think that the Bank of England's got to, I don't know, grab the stag by the horns, grab the bull by the horns, and move interest rates much, much higher than people are anticipating. To me, the reason that cable is weak, apart from me saying it should go down every week, as Ryan always reminds me, is basically the Bank of England's not going to do that. They're going to do 0.25%. Last time, was it 2 votes saying that they shouldn't move rates at all? And where else?
Yeah.
We've now got the highest inflation in the G7. Even Italy's got lower inflation than we have, which is, a hell of an achievement. And just one last thing, I get very annoyed with Andrew Bailey consistently, but he's talking about the weather and he's talking about climate. It's absolute bullshit. The UK food prices are rising at 19.1%. And I know I talked about it last week, and you're all amazed that I eat frankfurters from Asda. But the world FAO figure for food is 19.7% lower than a year ago. So how is UK food up 19.1%? What is going on with our food production? Are companies squeezing it so they can get a little bit more profit to pay, more corporation tax? I don't know. I just give up, but I think you're going to period of stagflation. Bank of England, broken old record that I am, is still hopeless. But it's really time that something should be done, and Bailey should forget about climate and get on and manage the bloody economy and hike interest rates. End of story. Thank you very much.
Dick, I've got another headline for you. You'll be pleased to know. You mentioned the labour market, and I'm glad you did, because Andrew Bailey was just asked about a wage price spiral at this Wall Street Journal event, and he said, I don't think spiral is the right word to use. God knows what word he would use, but at this point, I think you're right. The way I kind of see it is either the BOE do nothing, and the problem just gets worse. They do a little bit, and they're very timid, which is what they have done, and it does nothing to inflation, and it makes growth a little bit worse. Or they do the kind of bazooka option that you mentioned at the end, which would get inflation under control, but probably destroys your economy at the same time. I don't think any of those are particularly bullish for the pound. Arno, is there any optimism coming from South Africa at all, or are you as downbeat and bearish on the UK as we are?
Look, that I was bullish on sterling from, when was it? Early Feb, right? Today that changed. This was a really, really ugly print. And I think the reaction that we've seen from sterling today was very, very telling. I mean, to be fair, there was a few mixed print in the data. You know, we had PPI input prices, I think, coming in at 3.9. That was massively below expectations of 17. We had output core, I think, falling to 6. But on that core number itself, year over year at 6.8%, your like Adam said, your normal thinking would be, okay, this should be supportive for the currency. Now, we've got that old saying in trading, saying that if something can't rally on good news, or if it cannot sell off on bad news, that tells you a lot about the underlying market sentiment. And I think today's reaction showed us quite a lot. Now, you would recall last year, we saw a very interesting shift in the way that sterling reacted to CPI data. From about May to December, we spoke about this quite a lot on Twitter. There was that counter-cyclical reaction, right, to the inflation data, where we had higher inflation data actually being negative for sterling and lower inflation actually being positive for sterling. And that was because the markets weren't really focused on sterling from a rate differential perspective. They knew that rates had to go higher, but the focus was on what that meant for the economy, right? So the higher the inflation goes, the worse it is for the cost of living squeeze, the worse it is for the economy. Then what we saw from January to last month, we had the exact opposite, where for the first time in many, many months, sterling actually traded cyclically to the CPI data, where higher inflation was seen positive. And the reason for that was because everybody was slowing down, right? So with everybody slowing down, or expected to slow down, at least from a rates perspective, suddenly the Bank of England emerged as this bank that, hey, maybe they are the ECB that is going to keep on hiking rates because inflation is crazy high. And that supported sterling until today. Today's reaction, I think, is quite telling. The market is looking at this saying, you know what, for the past few months from January, higher inflation was good because it gave sterling a boost from a differential perspective. But now it's like, okay, everybody expected this to come down much lower, with core accelerating to 6.8, with energy falling out of the consumption basket. This is very, very negative stuff for the economy. And if you take a look, something that I always track is the City Economic Surprise Index. One of the main reasons that got me bullish on sterling versus the euro, back in March already, was because we saw that very clear divergence where everybody was so pessimistic on the UK economy that everything was expected to come in super low. We actually surprised to the upside for, I think, 7 or 8 weeks in a row in terms of economic data. That as well changed last week. We're now starting to see the data coming in slightly below what the markets are anticipating. So it's as if the market, it's as if economists and analysts, they're one step behind every time, right? They're too pessimistic just as things start to recover. And now they've gone a little bit too optimistic, and now things are rolling over. I mean, just to give you guys a number here, the City Economic Surprise Index went from 32. It's now down to, and this is in the last 5 days, we've gone down to 11. So it's rolling over. I think right now your baseline expectation for sterling should be lower. The other thing to consider is CFTC data. Even though we're not massively stretched like the euro, we've been seeing institutions piling into sterling longs over the past few weeks. I'm not sure if you guys saw that. We were, I think, trading at the 80 percentile over the last 52 weeks, and that's just shy of the 91 for the euro that everybody is so still long on. So I think right now, after this inflation, what it means for the economy, with the market that everybody was too pessimistic, and I think now they're too optimistic. So from today, I would change my stance on sterling for sure. I think we've got more downside, and the way that I would play that is simple, just looking at cable.
Can I just go back on a couple of points, Mike?
Oh, go on. If you make them quick.
Very, very quickly, very, very quickly. And of course, the lower the cable gets, or the lower sterling gets, the more you import inflation into the country, and you start getting in this downward spiral, which is a nightmare. And secondly, I wouldn't put too much importance on CFTC numbers. I mean, they're minuscule compared to what the FX market trades. I know that people do. If you're looking at corn or soya or coffee or something, then yes, but I certainly think in currencies, it's a minuscule amount. So just a bit wary of those figures.
Yeah, I think it's more... Oh, sorry, go on, Az.
I was going to say the telling point for cable was the fact that all the banks, there's a flow of banks went long cable a couple of weeks ago after it already rose about 8 points off the low. I think that was kind of everything you needed to know.
Absolutely. On that note, let's get on to the last round of the show. Right. I think I'm going to have to dock myself points for this one. And if a certain Mr. Paisley watches the show, then I'm sure he's going to be straight on WhatsApp bemoaning the fact that I've even mentioned it. But I think we do need to mention the debt ceiling, because as much as we all hate the pantomime that it is, it does seem like it's starting to have a bit of an impact on the market, particularly in terms of not only very, very short-dated treasury bills, but also some of the risk aversion that we see. But before we get into the meat of it, I just want to ask very quickly, one-word answer. Do we think a deal gets done, Arno? Dick? Adam? Good. Right. Now we've got that out of the way, I think we can focus on the more important matters, which for me is what comes next. And I think the two things that we need to think about, and I don't want to steal anyone's thunder here, is firstly, and I think either Adam or Dick mentioned it earlier, it may have been Dick actually, if a deal is done, what does it mean in terms of a dent to growth, lower government spending, job losses, etc. And then the other thing to consider is the Treasury have got to build up their cash balances again. The Treasury general account is running very, very low, as we all know, and as Yellen keeps telling us. They're going to want to build that up again so that they've got a buffer going forwards. Adam, let's kick off the last round with you. What are your thoughts on not the deal itself, but what the implications of a deal might be and what we should be looking out for next?
I don't know what's more ambitious, the demands of the Republicans or the fact that you think Ryan Paisley is going to be watching Trading Blows whilst he's on holiday. So in terms of, this is a stat that I think I brought out a few weeks ago, and this is like a really important bit of context that everyone kind of needs to bear in mind, where, kind of the real last material debt ceiling crisis was back in 2011. And that year, nearly all the S&P 500's declines came after the agreement was reached, because it had a significantly tighter fiscal stance than a lot of people had been anticipating. In terms of, kind of the direction of travel from what we're kind of seeing for these talks, it looks like it's going to be a case of spending in this fiscal year, well, the next fiscal year rather, will be lower than this year. And then it may begin to pick up in 2025. So yes, you'd argue there's going to be a slightly, to some extent, tighter fiscal stance. We've already touched on monetary policy. That's not going to be loosened anytime soon. And therefore, you would argue that overall it's going to be a pretty restrictive policy stance, which potentially could be negative for equities, could be down US treasuries and dollar up. But in terms of kind of looking beyond the debt ceiling, I think any kind of expectations of what fiscal policy is going to contribute are relatively limited. I think the election for me looms very large. If you take Biden, this episode has shown that his room for maneuver in the fiscal front is next to zero. That's done. So if you look forward to 2024 and you assume he's going to be the candidate, and then you kind of look across the aisle, well, the lead candidate for the moment for the Republicans is Trump. If you're asking me to kind of look into the inner workings of Donald Trump's mind and what he could possibly bring to the table for fiscal policy, I'm going to have to come up empty-handed on that. But you would potentially assume lower taxes, lower spending. So you could potentially see, a slightly more favorable growth outlook for the US further on into next year. But I don't think ultimately this is necessarily I don't think the debt ceiling debacle is really going to materially kind of change things. I think we'll see potentially a bit of a reality check that there will be some tighter fiscal stance. But I don't think any of this is really going to be a game changer. I think it's all about the Fed for me. I think if you do want some sort of stats, you're talking about the Treasury General account. There's going to be a lot of issuance in the market, which, Goldman Sachs said they could sell up to $700 billion in T-bills within an 8-week deal, and a net issuance will be about $1 trillion. So there's going to be a big pool of liquidity within the market, which could loom large. And I think, as Bank of America said, that would be equivalent to around about a 25 basis point rate hike from the Fed. So the growth outlook not looking too rosy from the US. We saw the manufacturing aspect of the PMIs was pretty disappointing. Yes, services going well, but a more hawkish Fed, as we've kind of discussed. I'm pretty essentially downbeat US growth in the short term.
Yeah, I think that's very much in line with what most are saying. Arno, what are your thoughts, particularly on this liquidity withdrawal that we may see? Is that another sort of brick that we need to add to this wall of worry that equities are, well, at the moment, struggling to climb?
Absolutely. I mean, I think there's quite a few alternatives that we can quickly talk about. Just as a side note, I had a really interesting question from a client the other day, last week, asking, just hypothetically speaking, if for whatever reason politicians are arrogant enough, let me not use Latin here, if they are arrogant enough to let something bad like a default happen, that's nobody's base case at all. But I do think it's worth having something, we always create lists, right? If there's going to be some sort of weird reaction to, if you're going to have a geopolitical event, have a list nearby of possible trades that'll be your go-to trade to trade. And just as a side note, and we can speculate on this, among the panel, but I think if we do get to a really bad situation and we do get something like a default for the first time in history, I think gold long, and what I told them is gold long looks for me like the most obvious trade that I can think of. The other one would be dollar Swiss and dollar yen shorts. Now, given the amount of debt that Japan holds, though, from the US, that would be more of a short-term play. I think I'm not sure how investors would feel about the biggest holders of US debt, in that scenario. So I think I would favor dollar Swiss shorts over dollar yen, but that is something that I'll be looking at. Obviously, as an initial move, you would expect equities lower, but I'm cautious on that front because I'm not sure how treasuries would react in that scenario. Probably yields and equities lower at first initially, but what comes after that, I'm a little bit less sure of. So just as a framework for those traders out there saying that if the worst thing possible happens, I think gold long is probably going to be the trade that I would look at, and dollar Swiss franc short. Now, in terms of this of the liquidity issue, I think even before we get to that, there's a few alternatives that politicians can that we need to look at. Once we reach the X date, we don't have a deal yet, Congress can always allow a temporary relief in order to just kick the can down the road. If they see that they are close to an agreement, they could just kick that can down the next 2-3 months. We'll be sitting there waiting for them to take it down to the wire again. But there is time to play if that happens. If that fails or Congress, doesn't allow it, then obviously Treasury would need to intensify that extraordinary measures. We'll probably get a government shutdown, which, it sounds very serious, and, the markets will probably sell off if we do get something like that initially. But it's important to note that on a shutdown, the government can still function, right? It's not like everybody stops working, oh my word, everything is shut down, the economy is going to crash. It doesn't work that way. There's still things that gets paid. It's just a limit on those payments. Where I think it gets interesting for markets if we get that happen is that we might not get economic data, right? Like the BLS might not be able to provide data that the Fed would need. So that would be a real bummer because the Fed will basically be flying blind if we have a shutdown. And if the BLS is under that umbrella, then obviously we won't have access to the data. So that could complicate how the markets think about things. I think at worst, it could just create range-bound price action if that happens, because everybody would wait for the Fed and the Fed would say, well, we don't know yet. We need to wait for the data until we can make up our minds. I think it's only after a shutdown reaches the end of their, creativity with swapping around payments, then things gets a little bit more hairy. But by that time, it's important to also note that I think on the 15th of June, we get that the additional tax revenues coming in. So if they can just, bite the bullet and kind of be creative until the mid-June, that might be enough. That tax revenue might be enough to take us towards the end of June. And at the end of June, they're going to get additional payments coming in. So I think there's a lot of things that can happen that the markets will need to just be prepared to, it's not like if we don't get a deal next week that everything just ends. This thing can carry on for the next 4 months. We hope it doesn't, but, there is all the possibility that we can see this thing extended, right? So in terms of the general, the liquidity with the general account, we talked about this, 2 or 3 weeks ago. I think that's really, for me, where, apart from the fiscal side, I think that's where the biggest focus will be, because it doesn't matter which way you skin it, when you drain liquidity out of the system, that's normally not good for risk assets, right? And I think they are looking at something. I read a Bloomberg article over the weekend that said they're looking at $1 trillion. Markets are expecting $1 trillion issuance. That's a lot. I think the market was looking at like 600 or 700 billion. If we come in at $1 trillion, that's a lot of drainage for the system. And I think equities will struggle. Now, on top of that, Adam put it very well. If you consider what type of an agreement they will reach and what that would mean for fiscal spending. So you've got the Fed staying on hold. you get liquidity drained from the system, you get the fiscal outlook damaging the growth outlook. It looks like the second half of the year it's going to be a very, very tough one for the markets to navigate. And in all of those scenarios, you probably favor the dollar.
Well, that's nice and cheerful, isn't it? Let's go to Mr. Matthews for the last word. He was probably around when the debt ceiling was invented, weren't you, Dick?
Oh, that's a bit harsh.
When was it actually? When did it first come to be? I don't actually know.
1960.
Oh, not
it's
far.
Been raised 78 times since 1960. So I presume
someone's done their homework.
That must have been when it started. And as Lord Frinton said on Twitter, this debt ceiling nonsense has been going on longer than it took Michelangelo to paint the original. And it's true. Let's come back on and pick something up that Adam said about 2011. And I may have misread this, but I think the S&P fell 17% in 2 days, just before they came to an agreement. And they had 3 days left, 72 hours left to come to an agreement. And I think the S&P fell 17% in those 2 days coming up to it. So if it's getting that tight to default, and you're 3 days away from default, when is it? The 7th of June or something like that? You're starting to seriously run out of time. Now, I do think you'll get an agreement. And what actually you didn't ask Michael was, when will you get the agreement? And
well, to me, okay, Mr. Matthews, when will we get an agreement?
I wish I hadn't said that now. Is it the Freedom Caucus in the States, who are sort of an updated right-wing version of the Tea Party, who are going hell for leather over this? I don't know. I think whatever happens, it's going to squeeze fiscal policy or cut fiscal policy. Biden's going to up, but we're coming into an election year. And you've got 2, if not 3, of the worst candidates I can remember. I'm not saying that we're much better over here or in Europe, but really Trump, Biden, and DeSantis, I think, is announcing he's going to run tonight. He's having a chat with Elon Musk. That's a great way to announce that you're going to run for something. What Trump does, God, looking at Trump's mind is like looking at Ryan Paisley's mind, isn't it? But whatever happens, that it is going to cut back on the economy, and combined with the credit crunch, I think it's really, really going to hurt. As I said earlier about Bloomberg, there's actually 570,000 jobs they could be lost over it. So I'm just a wee bit wary about everything's fine and dandy. It's all going to get done and it'll be great. That doesn't mean that you can't have a serious hiccup before you get to that. Going forward, you obviously go get mass issuance of bonds and bills and whatever. It's got to suck money out of equities. But it should keep the bond at the dollar bid, to me. So I think we could be in for a really, really interesting few days now, isn't it? It's a couple of weeks ahead.
Yeah. I think what one point I'd like, this is a really, really nerdy point, but I think some of your users may find it useful, Michael. So if we do get a government shutdown, we don't get this data, sometimes they do actually release the data, but there's no journalist lockup. So basically events like non-farm payrolls are going to be even more confusing than they are normally. So any of these data releases, I personally would potentially stay away from, or maybe get a Squawk service to help you navigate them. Who knows?
I was going to say, if you get yourself a good Squawk, then you won't have to worry about that. On that note, let's get on to the final scores. So, Arno and Dick, runners-up, 34. Adam, winner once again. Every time you come on this show, you end up winning. I don't know, how do you do it?
It's not when Ryan's here, because he just doesn't stop talking until he gets enough points.
No, he just doesn't stop talking, full stop. That's his problem. Good stuff.
Been in too early.
I was going to say, I did see that delivered halfway through. Good stuff. Well, thank you to the gent for joining us. Arno Venter, Dick Matthews from Pardus FX, Adam Linton from Newsquawk, and also to our producer, Kyriakos, for bringing this together so brilliantly as always. We'll be back with another show this time next week. If you enjoyed the show, leave a like on the video, leave a comment, let us know how you're trading the markets, and we'll see you again soon. Thanks for watching, and goodbye for now.